Moving on to retained profits, which is one of the most crucial sources of finance for many businesses. The concept of retained profits is truly at the heart of business growth. Essentially, a business makes a net profit and then simply reinvests this profit back into the business rather than receiving it personally or making a payment to shareholders. Retained profits are seen as a long-term internal source of finance, providing the owners with complete freedom on how they reinvest it back into the business. They could spend it on expanding the range of stock to attract more customers, it could be spent on machinery or tools to increase efficiency, or it could just be left in the bank account for a rainy day. Some key advantages of using retained profits as a source of finance include the fact that the owners of the business have complete control over how this is spent in the business. Importantly, by retaining its profits, the business does not have to repay this money back to any person or bank in the future, and doesn't have the additional charges such as interest, which is added in many other sources of finance. However, there are a number of drawbacks to this source of finance. Firstly, the business owners should be aware of potential disagreements in how the profit should be shared or retained, which may upset shareholders if they believe they should have received more of this retained profit personally in the form of dividends. Also, the business cannot rely on retained profits as a consistent form of finance, as they are not guaranteed to make a profit year on year. It's also very important for business owners to consider the impact of retaining profits every year, as this can make the business look less attractive to potential investors in the future.